Welcome back to Smart Stock Sam, the channel where data drives every decision without being influenced by the noise. If you landed here because you watched a perfectly good stock bleed 8% in a single Friday session, and you're wondering whether the SanDisk rally is dead or whether this is the single greatest buying opportunity of the year, you are exactly where you need to be. Today, we are going to settle that debate with hard numbers, clean technicals, and the kind of institutional-grade breakdown that most retail investors never get access to. We're talking about where SanDisk is headed next, why last Friday's red candle is not what it looks like, and the specific price targets that could make this week one to remember. Stay with me, because by the end of this video, you will see the full picture. And that picture points to $800. But before we get into the roadmap, let's acknowledge the elephant in the room. A stock reports a 672% explosion in net profit, and the market's reaction is to sell it off by 8%? If that sentence made your head tilt, good, it should, because that is exactly the kind of disconnect between price and value that creates generational opportunities. This is Smart Stock Sam, and today we are breaking down the full anatomy of that dip, the technical blueprint for the week of March 23rd through the 27th, and the hidden mechanism sitting inside the options market that could turn this thing into a vertical rocket by Wednesday. Do not go anywhere. Let's start by recapping what has been an absolutely wild week for SNDK. Earlier this week, the stock did exactly what our roadmap called for. It blasted clean through $750, achieving our primary objective with conviction. Momentum was real. Institutional buyers were active. The narrative was locked in around AI-driven storage demand and a structural NAND shortage that isn't going away anytime soon. Everything was working. Then Friday happened. An 8.08% single-day pullback. The kind of red candle that shakes out the weak hands and sends the headlines into a frenzy. But here is what those headlines won't tell you. That drop had nothing to do with the business. It was the mechanical result of a scheduled lockup expiry, a known event, a predictable event, that temporarily flooded the market with supply. Meanwhile, the actual catalyst driving this company forward, a global NAND shortage extending all the way into 2027, is only getting stronger. The dip was noise. The trend is still your friend. And if you've been following our specific price targets on this channel, you already knew this chaos was part of the plan. Let's look at the accuracy of our forecast and let the numbers speak. On March 16th, we laid out a detailed roadmap for SNDK. We called for a primary test of $675. The stock didn't just hit it, it obliterated that level on day one, printing $714. We then identified a stretch target of $725. By March 18th, SNDK was trading at $761. We called a consensus ceiling between $750 and $760. The stock closed Wednesday at $753 and Thursday at $772. Every major level validated. The technicals were speaking clearly all week. Are you listening? So why did the stock fall off a cliff on Friday? Let's break down the anatomy of that dip, because understanding it is the key to everything that comes next. Three things converged simultaneously. First, a liquidity event. Over 2 million shares, held by company directors and Western Digital, became freely sellable as a lockup agreement expired. That is a wall of supply hitting the market in one session. Second, we had quadruple witching, a quarterly event where an estimated $5.7 trillion worth of options contracts expire all at once, creating massive, artificial volatility that has nothing to do with any individual stock's fundamentals. Third, the combination of those two forces created a temporary supply shock that pushed price down 8.08%. That is it. That is the whole story. A healthy technical breather after a 1,200% one-year run. The fundamental trajectory of the company did not change by a single basis point. Once you understand that Friday was mechanical and not fundamental, you start to see the massive foundation being built beneath this stock. The strong buy case for SNDK rests on four unbreakable pillars. First, explosive earnings signaling immense and accelerating profitability. Second, a fortified balance sheet that has been rebuilt from the ground up for long-term financial safety. Third, a structural supply deficit that hands the company extreme pricing power in the most important semiconductor segment on Earth. And fourth, institutional ownership concentration that creates a near impenetrable floor under the price. If you are looking for a perfect setup, this is as close as you will ever find in this market. But when you dig into the actual numbers, it gets even better. In Q2 of fiscal 2026, SanDisk did not just beat expectations. They humiliated them. Net income exploded by 672% to $803 million. Revenue surged 61% to over $3 billion. But the real story for the long-term holder is the balance sheet transformation. Total debt has been slashed from $2 billion down to just $603 million, a 70% reduction achieved in record time. This is no longer a company weighed down by leverage. This is a lean, aggressively profitable, cash-generating machine that is now free to dominate its sector without constraint. And that sector, it is experiencing a supply crisis unlike anything we have seen in the semiconductor space in years. We are witnessing a structural NAND shortage driven by the vertical demand curve of AI-driven storage, while available supply remains essentially flat. Traditional hard drives are already completely sold out through late 2027. Could you have imagined a year ago that storage would become the single biggest bottleneck in the AI build-out? As the market's only pure-play NAND provider, SanDisk captures maximum margin from this deficit. They do not just have pricing power. They have take-it-or-leave-it power. Their customers have no alternative. This supply advantage has elevated SanDisk to something far more important than a component manufacturer. They have become the gatekeeper to AI inference at scale. Their BULLISH ramp is gaining serious traction with hyperscale clients who need unmatched speed and density. The 128 terabyte Stargate platform offers storage density for enterprise AI that nothing else on the market can touch. And the strategic alliance with SK Hynix in high-bandwidth flash technology cements SanDisk as the critical bottleneck provider for the entire global AI infrastructure stack. If you want AI models to run inference at speed and scale, you need SanDisk's flash memory. There is no workaround. There is no substitute. Sophisticated, long-horizon investors have absolutely noticed this shift. 82.58% of the entire float is now held by institutions, 822 separate institutional owners. This level of concentration creates what we call a structural floor. When the big money owns this much of the float, they are not selling because of a one-day dip triggered by a lockup expiry. They are the buffer against retail-driven sell-offs, and more importantly, they are the launchpad for the next technical leg higher. When you are buying into this setup, you are not trading against the institutions. You are riding alongside them. Wall Street is also officially playing catch-up. Since the earnings explosion, Citi raised their price target to $875. Bank of America is sitting at $850. And KGI Securities just issued an outperform rating with a target of $992. That represents approximately 39% upside from current price levels. With a Zacks rank of number 1, the analyst consensus is as clear as it gets. SNDK is a strong buy. But here is what I want you to consider. Even those aggressive targets may be dramatically undershooting the real long-term value. When we run a discounted cash flow model on SanDisk's current earnings trajectory and growth rate, the intrinsic value calculation lands at $1,994 per share. The stock is currently trading near $710. That means even after a 1,200% run from its lows, SNDK is still trading at a 67% discount to its calculated intrinsic value. And looking ahead to 2027 earnings estimates, projections point toward a theoretical price target of $3,355. The institutions buying this lockup dip are not just buying a bounce. They are buying a dollar for approximately 33 cents. Now let's zoom into the actual price tape from the last 48 hours, because this is where the setup gets precise. Thursday was a masterclass in momentum. SNDK hit a peak of $777 on the back of a strong rotation into tech and the inference inflection narrative. Friday opened at $771 before the lockup selling began to dominate the tape. Yes, price broke below the 20-day exponential moving average. But here is what matters. The stock found immediate, rigid support right at the $700 psychological level. The bulls stepped in hard at that line and they defended it. That floor has now been identified and tested. With that support established, here is the exact blueprint for the week of March 23rd through the 27th. Our entry zone is between $710 and $718. This is where the lockup supply is being absorbed and where the risk-to-reward profile is most favorable. The stop loss is placed at $682, sitting just below the 50-day moving average, a level that would represent a genuine technical breakdown rather than a temporary dip. From the entry zone, the first target is a return to $750, our former ceiling now acting as new support. Above that, the targets are $761, the prior all-time high of $777, and our ultimate stretch target of $800. This is a textbook buy-the-dip setup with an asymmetric risk profile that is hard to ignore. And now, for the mechanism that could make all of this happen faster than most people expect. The options market is currently primed for something called a gamma squeeze. Here is how it works in plain language. There are 8.5 million shares of short interest in SNDK, that is over 6% of the float sitting short and waiting to be squeezed. The trigger point is a reclaim of $750. Sitting at the $800 strike for the March 27th expiry is a massive wall of call open interest. The moment SNDK crosses $750, market makers who sold those call options will be forced to buy the underlying stock to hedge their delta exposure. That buying accelerates price toward $800, which forces even more hedging, which accelerates price further still. It is a self-reinforcing loop that can send a stock vertical in a matter of hours. Could it trigger this Wednesday? The setup absolutely allows for it. Is it guaranteed? Nothing in markets ever is, but the fuel is sitting there, and the match is already lit. Now, before we wrap up, a quick but important reminder. Everything discussed in this video is for educational and informational purposes only. Smart stock. Sam is not a licensed financial advisor. Nothing you have heard today constitutes personalized investment advice, a recommendation to buy or sell any security, or a guarantee of any outcome. Markets are inherently unpredictable, and all investing involves risk, including the risk of losing your entire principal. Always conduct your own due diligence and consult with a qualified financial professional before making any investment decisions. Past performance, including any price targets we have hit historically, is never a guarantee of future results. So here is where we land. The Friday supply shock has been absorbed and defended at the $700 line. The fundamental story, a 672% earnings explosion, a 70% debt reduction, and a structural NAND shortage, lasting into 2027, remains completely intact. The institutional floor is deep and wide. Wall Street is raising targets. The DCF model shows a 67% discount to intrinsic value. And the gamma squeeze mechanism is primed and waiting for a single trigger at $750. The path to $800 is not just open. It is the highest probability outcome on the technical and fundamental tape right now. Don't let the red candles scare you. Let the data guide you. Now here is the question I want to leave you with, and I genuinely want to read your answer in the comments. If SanDisk is trading at a 67% discount to intrinsic value after a 1,200% run, and Wall Street has targets as high as $992, do you think institutional investors are done buying, or are they just getting started? Drop your answer below. I read every single comment, and the best ones get featured in next week's breakdown. If this analysis brought clarity to your trading week, hit that like button right now. It takes 2 seconds, and it tells the algorithm that this kind of data-driven content deserves to reach more investors. Subscribe to Smart Stock Sam so you never miss a price target, a squeeze setup, or a buy-the-dip moment like this one. And if you want to help push this video to the top of YouTube's hype leaderboard, share it with one trader in your circle who needs to see the full picture before Monday's open. The path to 800 is clear. I will see you in the next one.